Hi, it's Austin Eaton with Coldwell Banker Realty with the spring market update for the Twin Cities. It's been a crazy year so far. Let's see if I can make some sense of it for you. A question on nearly everyone's mind has been what is going on with the value of real estate right now? Many people have lost a tremendous amount of money in their retirement funds or investment funds through the stock market and other means. More than 22 million people over the last month have filed for unemployment in the US. There are all sorts of question marks as to what's going to happen next and what is going to happen with the rest of my assets. What I'd like to stress to you is that a recession or an economic slowdown does not always mean a housing crash. And in fact, in 4 of the last 5 recessions dating back into the 1980s, there has been little or no drop at all in housing prices. So I'm going to run you through a few slides here and talk about that very thing. A recession does not equal a housing crisis. One of the underlying fundamentals that I see as different now than in the Great Recession in 2008, 9, 10, etc., was the run-up to those times. If you look in these left-hand bars, you'll see that housing appreciation was crazy. It was a runaway train, and you couple that with some of the other pieces that I'll show you in a moment, and you were bound for trouble and bound for a bubble. Here in the last 6 years, while the housing market has been a growing market and has been very healthy, we don't have runaway appreciation. Another piece here is the the mortgage availability index. If you look back in 2006, it was off the charts. There was actually a dog that qualified for a mortgage. There was almost no vetting to figure out whether somebody was qualified to pay for a home. Go ahead, you got a mortgage, go buy the home, you're good to go. Since then, obviously changes needed to be made, and you can see along the graph here to the right-hand side, it is still difficult to qualify for a mortgage as it should be. Another thing that is propping up the housing market and making sure that we do not have another housing crash coming toward us is the fact that we have very little inventory. Historically low inventory on the market right now. And you can see up in the red is a buyer's market. You had 2006, 2007, 8, 9, 10, where it was an extreme buyer's market because there was so much inventory and the prices plummeted because of that. Today, we have a historically low inventory, which supports the prices on homes. Even in a crisis, the home prices, because of lack of inventory, should remain elevated. Another thing that is going to support us right now in terms of keeping the health of the national housing market is the affordability and the percent of income needed to buy a home. Back in the 80s up to 2000, it was just about 20%. In the housing bubble, people needed more than a quarter of their income to buy a home because of high mortgage rates and out of control inflation on the prices of homes. Today, we have incredibly low mortgage rates, 50-year lows on mortgage rates, and that's keeping affordability very, very easy. And what it does is it gives the buyer more buying power in a market right now, and those who are in the market can take advantage of that. Here are some other great pieces that can illustrate why we're not headed for a similar crash as we did in the Great Recession. Right now, 53.8% of homes have at least 50% equity. 37% of homes are owned free and clear. They have no mortgage. They have no debt on the house. And then of the people who do have a mortgage still, the average equity is $177,000. This is quite different than in 2008 and the years leading up to the housing bubble. And this will also speak to that. Home equity cashed out. A lot of homeowners in 2005, 6, 7, 8 were using their homes as essentially an ATM to help buy depreciating assets, to help afford a better lifestyle, and they thought they were never going to see the end of that. Well, that came crashing down. There were over $824 billion in home equity cashed out through home equity loans and lines of credit. Today, over the last 3 years, only $232 billion. That's still a big number, but look at it, it's just over a quarter of what happened in the leading up to the previous housing crisis. The homeowners here in America are not as leveraged as they were 12 years ago. Let's talk about what's going on locally. Up until the middle of March, this season had been amazing. We had been off to an incredibly hot start due to the fact that we had very low interest rates. We had inventory that was coming up a little bit so that the buyer had more selection, but it was still a seller's market. So through March, we have a 12% increase in new listings, a 12% increase in closed sales, and the median sale price here in the 7-county Twin Cities metro is up 7.7%. That accounts for the last 2 weeks also of March, which were in slight decline because of the start of the stay-at-home order here in Minnesota. But an incredibly promising start to the year, and it tells us that the market has been incredibly healthy here to start the year and should support a comeback once we're allowed to leave our homes. Listings and pendings here over the last couple weeks have actually increased. So the first couple weeks of the stay-at-home order, I saw listings plummet, and I saw the number of homes going under contract drop as well. And I was worried that everything was going to grind to a halt. There were a number of areas around the country where the market has just stopped. And that's understandable in a lot of cases. Here in Minnesota, we've been very fortunate with things bouncing back here over the last couple weeks. So in last week, we had 2,311 new listings come on here in the metro. We also had 1,600 homes go pending. That's a huge number. It's not quite as high as it was a year ago, but considering the fact that most of us are staying home, it's pretty amazing that this kind of business is being done. Here in Dakota County, 159 new listings and 110 pending sales just in the last 7 days. Check this out. The amount of showings, as you can imagine, March 15th just went through the floor, and it ended up being below where we started the year. So as you know, there aren't a lot of people out looking for homes the first week of January, or as you can imagine. Well, we went below that number, and as people started understanding that there's a light at the end of the tunnel and that they still need to buy or sell a home, the showings started picking up. Some of these showings are virtual, where the agent goes in and shoots a video and does some live maybe FaceTime or Zoom video with the client and shows them around the house, shows them the size of the closet, the size of the garage, light exposure, things like that. And then the agent can vet the quality of the finishes within the home during that showing. So a portion of these showings that we're seeing here are virtual showings. Quite a few of them are actually in-person showings, and we are taking special safety precautions to make sure that the buyers are protected by making sure that the agent is the only one who's touching doorknobs, touching light switches, and opening doors that are in the house so that the buyer can see them without exposing themselves and exposing the seller to infection. I am carrying disinfectant wipes with me the whole time, wearing gloves and a mask when I can, and making sure that Safety is a #1 priority for me. But I'm really, really encouraged to see the amount of listings and showings that are picking up now. My takeaways as we head into the second quarter of 2020. #1, safety. The industry is developing ways to protect all parties so that we can do most of this process virtually or with limited exposure. #2, those that have a need to move or a great incentive to do so are continuing to buy and sell homes. We can expect a healthy market from now until when the stay-at-home order is lifted. And we'll continue to see multiple offers on well-presented, well-priced properties, particularly those under $500,000. I expect to see a flattening in the market. When we look back at Q2, we're not going to continue to see that rise in prices that I talked about earlier. And we'll probably see a flat market in Q2 with a rise later in the year, but not at that 7.7% rate of increase, more reasonable rate of increase for the rest of the year. People have asked me about whether we expect to see more foreclosure properties. And a lot of people have lost their jobs. Over 3 million people have filed for forbearance on their mortgages. And that is a huge number, and it's a little scary. I would expect that there will be some bank-owned properties later in the year or into 2021. But thankfully, the government is putting in a 60-day moratorium right now on foreclosures and on evictions. And once that time period is up, it still takes quite a while for a foreclosure to be processed. I hope that everybody's able to hold on, but those who aren't able to hold on, those properties will eventually enter into the inventory in our market as a bank-owned property. I wouldn't expect, though, for there to be some bargain basement deals. The reason behind that is we have such low inventory that these homes are going to be bid on by multiple people, and the values are going to remain up on those properties. Don't go looking for fire sales. Your biggest bargain right now is the interest rate that you can get as a buyer. I think that once people feel secure in leaving their homes, the second spring market is going to hit. We were on such a ramp up this spring to get to a hot spring market, then put the brakes on. And then I think once we're able to get back out and feel safe getting back out and looking at homes, putting in offers, etc., I think we're going to see a robust spring market in the summertime. June, July, August should be an extended spring market for us here in Minnesota. If you have any questions about how the COVID-19 crisis is affecting the values of your property or your neighborhood or anything involving real estate, I would love to be a resource for you. Until then, stay safe. Thanks for tuning in today.